This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then, I can focus on what I want to do. Visit your online broker today to learn more.
Welcome to the very first edition of the Futures Edge. I'm Jim Iuorio, and the first thing I want to say is, it's a Friday before happy hour. I really appreciate you guys being with us here. And as I've said a million times, I love trading. I love to talk about trading. On this show, we're going to do both. We're going to specifically hone in on futures trading. Okay, if a lot of you guys don't trade futures, and futures have this reputation of being, a very dangerous instrument, and they certainly are because of the amount of leverage they allow you to have. So the thing I'm going to stress a ton is know what your risks are. We don't make recommendations. We tell you what we're looking at, and we give examples of how we're representing what we're looking at. We don't know the depth of your pockets, your risk tolerance, your timeframes. So that's why we don't make any recommendations. I always talk about futures being the most powerful tool in your tool shed. If you know how to use it properly, the job gets done efficiently. If you don't, somebody's going to lose a thumb. You're going to hear that a lot because it makes a difference. But again, thank you guys for being here. We're going to dive into stocks, 10-year, crude, and dollar proxies today. And our first guest is, Bob Iuorio. I've known him for 30 years. He's a good man, good friend, chief market strategist, co-founder of Path Trading Partners, and also co-portfolio manager of Stock Think Tank. Did I get that right, Bobby? And another thing about Bobby, too, is that there's two different kinds of Italian Americans. There's the ones who are very kind of calm and normal like me, and then there's the chain wearing, IROC Z driving Bobby Iuocio's, and that's kind of who I want to be someday. So I'm going to grow up to be Bobby. Bobby, thank you for having me.
Yeah, well, first of all, in the vein of being that sort of IROC driving, I had two IROCs growing up, by the way.
Did you really? I was just joking, and you really had them.
Wow. A black and gold one, and I had an electric blue one after that. So I had two of them. And I had a rope chain with what some people would call the chili pepper on it, but that was the Italian horn. And in the fact that I want to correct you on Stock Think Tank, it is the Stock Think Tank.
It won't happen again. Trust me on that.
But otherwise, you got it all right.
Okay, everyone today has been talking about, what's been going on in GameStop. Some lunatic tried to explain to me a couple of days ago what GameStop actually did as a company. And I was like, what are you talking about? Who cares what they actually do? That's nothing to do with the story. Do you think what we're seeing in GameStop and those other names too, I'm just going to use it as a catch-all. What is the ramifications for the greater, broader market?
Well, first of all, I'll throw a couple of things in. And I'm stealing this from my partner in Path Trading Partners, Mike Arnold, where he talks about the weakest question in the hierarchy of questions being why. That is the weakest questions for traders to ask themselves. Why is this moving? Traders need to act. They need to know what is going on and what they're going to do about it and how they're going to affect their fix or their opinion into what is going on in the market. Having said that, when you have moves like this that damage some hedge funds, and I want to throw out 95% of the hedge funds are long in the world. So there's only about 5 or 6% of them that are short hedge funds. So when you talk about this retail against the hedge fund, that's not what's happening here. It's retail against a couple of hedge funds, and that's fine. I'm all for that. But when you see things like this happen, you see hedge funds raising money and selling other stocks that are in 401ks, that are in public pensions, things like John B. Sanfilippo and Sons, which is one we just exited today because a stock that normally trades 2 or 3% per day traded 10% yesterday on its range. So you get crazy moves like that. It has ramifications. You're seeing it in the broader markets. And it's one of the reasons I like futures so much is you have things that are just specifically to steal the name of pure exposure. It's pure exposure to a specific thing. And you can actually affect a lot of change that way.
Okay, everyone clutching their pearls like this is some terrible thing that's happening in markets. To me, I like when risk occasionally lifts its head up and slaps somebody in the face who might have been complacent prior to that. Do you agree with that assessment?
Absolutely agree. I think one of the things they're trying to prove is collusion on the message boards, and that's above my pay grade. Because if you're colluding, whether you're individuals or whether you're groups, if you're colluding to manipulate price, it's against SEC regulations. If you're saying,
Amen. Underline that. Yes.
we want to push the price here, let's all do it together. If you're all in a room saying we should buy this, nothing wrong with that. And by the way, you know about idea dinners. You and I have both been at those idea dinners. If they're going to crack down on the retail, they got to crack down on the institutional. It's all about transparency.
Good, Bob. We talked about futures. And we're going to be talking about futures a lot. The one, CME products, and again, I've been a CME animal for 33 years. That was all I knew at one point in time. I thought everybody traded futures up until about 15 years ago, and I found there was other things to actually actively trade. So the CME has the NASDAQ contract, the E-mini S&P contract, the Russell. The Russell's been an interesting trade. I put a video out a couple months ago about the rotation from NASDAQ into the Russell. And Russell was kind of the little brother of some of these contracts up to a year ago, but they've seen 40% rise in volume in the Russell E-mini contract over the last year. I'm going to talk about what is near and dear to my heart, and that's options. I trade options in these things all the time. And today I put on a trade, and Bobby's heard, I put on trades like this all the time, and it's my favorite thing, and I'll explain why. So next Friday, February 5th, is the week one S&P. I put on the 3750, 3800, 3840 fly, or 3845 broken call fly. Now, the reason it's broken is because there's 50 ticks between the first call spread that you're buying, and then you're selling a 45 tick call. So I'll make that a little smaller, a 45 tick call spread after that. I bought it for 11 and a half ticks. So that risks $575 to make 1925 if it goes to 3,800. But it's never going to go right to that spot. That's not why you trade call flies. It's a lower risk way to expose yourself to the market. And then if you get a double or triple in the first couple of days that you have it on, you exit out and look for the next trade. Do you like the direction, Bobby? Do you like the way I expressed it?
There's a couple of things I like about this trade. I always like limited risk. And that's one of the things people don't understand. You're in futures, your risk is in your position size. The ability to limit your risk is then up to the type of contract that you trade and the way you structure it. But you can have a small position size and limit that risk, assuming the risk you're going to talk about is one contract. You look at it from the perspective of where you're putting that trade on today. We just bounced off the 50 on my charts. So I like that. And when you go out on a wider, longer time frames like weekly and monthlies, there's this uptrend by the S&P is not over. Now, this volatility is also still going to continue. We had volatility above 30, if you look at it based on the VIX, for 3 days, and that's above an already elevated volatility that we had been in the mid-20s. So I think that's going to be around for a little while until they sort this stuff out. But I do think the market's going to recover. I expected an ugly January for a number of reasons. I got it for another number of other reasons. I think it's going to bounce back.
Now, one thing Bobby mentioned before too is volatility is elevated, and that's one of the reasons I would not just buy a call or buy a put. It's too expensive at this point in time. You have to make that work for you, in my opinion. So buying a call spread and selling a call spread seems to kind of mitigate the expensiveness of the volatility. Let's move to rates, particularly 10-year. There's an article I read today that Japan was thinking about letting their yield curve steepen and not buying as many JGBs. And this makes sense because we've seen a lot of buying of steepeners in our markets over the last couple months. And I think 10-year rates are going higher, but I think they're going higher for a couple different reasons. I think they're going higher because I think three things are going to converge in about 2 months. The vaccine is going to reach critical mass, so people are going to be more confident in going out and doing things. The winter is going to break, which normally gives somewhat of an economic boost at that point in time when people come out, particularly in the Midwest or big part of the country, from their bunkers like we generally stay in. Right around the same time, the government might be considering their 1.9 trillion with a T package. So I think that we're going to have to start worrying about inflation a little bit too. So I've been for the last couple weeks, looking at 10 years from the short side, meaning higher rates, lower prices, thoughts?
Yeah, so I wrote this down because I did a video that I do for the CME every Friday that we post on Twitter. They posted on CME Active Trader. I think that's at CME Active Trader, if I'm not incorrect, about basically what happened in the yield curve in January. You had a yield curve that started twos, tens. Okay, so twos to tens, opened the month at 82, went to 97, went to 103, went back to 97, went all the way down to 90, back at 101 today. I mean, rates. To see a yield curve do this, to see it move from basically 82 to 97 to 101 was amazing. And then have it move back down to 90 and back up to 101, it's volatile. And that tells you that inflation, in my opinion, is in play. It's for sure in play. It's not like last year where people said there's no inflation in sight. Remember how the Fed said they weren't even going to talk about raising rates?
I do.
Now talking about seeing inflation. And I think you're seeing that in the 10-year.
So yeah, there's a lot of people who don't really understand inflation because we haven't seen it in many years, but I actually think it's going to become something we're concerned about in Q1. So I have another trade on that for rates. 10-year right now is about, I think, 109-ish. And just even a couple of weeks ago was at 115. It came down a little bit as well. So my trade I have on in the 10s is the week 2. So that's 2 weeks from now. So that's February 12th. I have just a regular old put fly. It's the 136 and a quarter, 136, 135 and 3/4 regular weighted put fly. I bought it for one tick. So that's, I bought some of them, but if you buy one of them, it's only risking $15.625. That's literally $15 to potentially make 484 and change. To me, the risk reward on this was amazing. And again, perhaps we lose, but to get 2 weeks to go up to 115, to me, that seems great risk reward. What do you think, Bob?
Yeah, so a couple of things. Fundamentally, I like it. I think we will get to 115. When I see things skewed like that, I always think of my football betting. When I see a line that seems crazy and I bet my opinion of crazy, I'm always wrong. So when I see a line that seems crazy, I usually take the opposite of what I'm actually thinking. So for example, if the Bears were favored by 10 over Green Bay, I'd be like, oh my God, you got to take Green Bay. I probably should bet the Bears. So it worries me that you get 2 weeks for that little money. It honestly does. It seems priced for not perfection, but as well as I do, when you have a big risk reward like that, you generally have a lower percentage of it winning, but I like how cheap it is for sure.
Right. And again, the market's telling you that you have a low percentage of making money on this trade. I'm perfectly comfortable with that. One thing I liked, and I'd like you to comment on it too, is that throughout this volatility, normally we see a flattening of the yield curve. Today, particularly at one point in time, the S&P was down about 100. We didn't see that at all. I thought that was interesting, and that was one of the reasons I initiated the trade. Do you think that's significant?
I do. And actually, if you'll allow me for a second, I wasn't going to do this, but I'm going to do this. There was a book called When Money Dies. All right. And here's a quote from that book. And this is from Germany in 1921, just before this historical period of hyperinflation. Since we're talking about inflation, I want to read this to you real quick. And I just lost it. And that's what happened with live TV. But basically, here it is. I got it back. Live TV, live internet.
Old guys aren't good with technology. You guys, your viewers should understand that. But anyway, go on.
My IROC had a stick shift, and that's all I knew. So here's what it was. This is from 1921. Tell me if this sounds familiar. Gambling on the stock exchange had become the fashion. The only way to avoid losing all one's money and perhaps to add to it was gambling on the stock exchange. Many new bankers were giving people advice. The flight from the kroner governing all transactions. Communists are seething with discontent. A mob has attempted to set the parliament building on fire.
Wow. Because what Bob is talking, yeah, we're talking about having to be in stocks or having to be in something other than your currency. And if you want to underscore what's happening now, all you have to look is things like Bitcoin, things like Tesla, things like freaking Gamestop. Sorry, I don't. That's not a swear word, but anyway, that's. I don't have to apologize for that. But this is what's happening. This is what is happening, and yes, it's in the infant stages too. And no, I'm not saying that a dollar collapse is imminent, but I'm saying that a worry about a dollar collapse not only is it imminent, it's already here, right?
Yeah, it is. And again, you asked me to comment on your logic for putting on the trade. I do think we've got probably 2 to 3 quarters left. and inflation will become the big topic of conversation. I know you got to go to a break, but real quick before that, talking about your frickin' right there. Did you see Leon Cooperman swear live on TV the other day?
Did he really? If he can, I can too then, right? I mean,
Leon Cooperman on CNBC swore, and he's about 100. So I think it was
we'll
okay.
be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back to the Futures Edge. I'm Jim Iuorio, and we're talking with Bob Iuorio. And the one thing I wanted to say before we start, we're talking about futures. And again, futures, the most powerful tool in the shed. You guys have heard it a million times too. When you start to hear some of these stories about people trading GameStop, and I read a story about a kid who had mortgaged his mother's home to put it into GameStop, and I was supposed to feel sorry for him when I read that. If you have any inclination of taking risks of that magnitude, don't trade. Go away from your keyboard, go to your tool shed, take out your biggest hammer and slam yourself in the forehead with it. You'll get more utility from doing that. Anyway, Bobby, we were just talking about profligate spending, essentially, rates too low for too long, worries about currencies. When you read that quote from Germany in 1921, I'm looking at currency proxies. I'm in Bitcoin. I'm in gold. I've been in and out of silver a couple times, and I'm not. What are you looking at in that space, and why?
So also in gold, and I'm also in Bitcoin. With Bitcoin, I took my initial investment out. I more than doubled it, and I took my initial investment out, and I barely look at it now. Every once in a while, I hear that Bitcoin was up 15, 16%. I'm now in a situation where I have an asset. I'm going to call it an asset because I believe it is one. Whether it's a solid asset or not, I guess we'll find out in about 10 years. But I'm in an asset that can be legislated away. Otherwise, it's going up. That's honestly my opinion of it. And you could discuss kind of the little nuances here and there about whether it's a currency, whether it'll ever be spendable. In my opinion, it's gotten to the point with CME futures contracts, now an Ether contract coming up. The CME to me is like the great validator of these things, because I started accumulating Bitcoin when they released a futures contract, because that was a signal to me.
Right. That's the moment I bought Ethereum just a month ago when they announced that contract too. And the religious cult members in the Bitcoin world, the true hodlers, when they hear Bobby say that they can legislate it away, they'll say, no, they can't. No, they can't. They'll scream. But I'd like to point out to them is that they don't have to legislate it away. They can make it illegal. Yes, it's probably unenforceable too, but it could scare enough people out of it to make tremendous shocks back and forth in the price, whether it's a legitimate story or not. That's important, correct?
Yeah, and if it gets made illegal, do you think the CME contract stays listed? It doesn't.
Of course not, right?
Right away, you've got the large institutions that tend to hedge just gone. Now, having said that, I don't think it's going to get legislated away. I think they're going to want some transparency. Now we get into the technology part that is above my head. But I'm not selling the profits that I've made on Bitcoin. If Bitcoin goes to zero, then I'm at break even. Otherwise, I'm hanging on to it and I'm not letting go.
Right. I don't actually trade Bitcoin, so to speak. I just have it set up, and I have for many months. Every Wednesday, it buys a certain amount. And when it gets to amount, and again, this in my mind is a dollar hedge. I haven't really traded it particularly. Before we get to your trade, which I know is in copper, and I think it's very, very interesting, of gold, silver, and Bitcoin, of those three, which do you think is the best one to hedge yourself against dollar risk at this point in time?
So okay, it's funny. You would say Bitcoin has too much volatility to do that, but Bitcoin actually has been less volatile than Apple if you look over the last 60 days. Apple's had more 60-day volatility than Bitcoin has. Now, granted, Bitcoin's got straight up. That's a big part of it, but whatever. I think probably silver, because I think silver has the reactionary sort of characteristics while still being an actual physical metal you can hold. And I think to me, that's the key. If you can lose 270 million in Bitcoin by losing your password or losing your wallet, as we've heard, that doesn't make it as valuable as me being able to put some silver in my desk drawer here. Gold hasn't been doing what it should do. And I think that's because of the perceived lack of inflation. I think that'll change soon.
I do too. And I like, so I've been in the silver trade twice this year and done pretty well in it. Right now, I expected it over the last 2 days. Well, once it started its move higher, 27.80 was about my level. I want to see it consolidate around there. And as soon as it begins to make its next move, I plan on being part of that. You chose copper. Why copper? Is this part of a growth story as well?
To a certain degree. So the growth story drove copper. I think a lot of people are looking at copper having moved up since the lows of the pandemic. But since January 2016, copper's up about 258%. So why do I want to be in something that's up 258%? Because we're still in a very slow global economy, of which copper is a massive component to a growing global economy. So number one, there's that. Number two, people don't realize where copper is actually going to be used. So a typical combustion automobile, 18 to 49 pounds of copper in that car. You go to a hybrid, you're a gas electric hybrid, about 85 pounds of copper. A plug-in gas electric hybrid, 132 pounds of copper. Full electric vehicle, 165 pounds of copper.
The Moscow mules we sell at Brant's of Palatine, my restaurant, are served in copper mugs, and we sell a lot of them, but please continue.
Well, I won't drive the electric vehicles, which have now become 3.2% of global auto sales from 1.4% in about 2017. And that's of a shrinking global market. It's about I think it's about 2.3 million vehicles. So it was 3.2% of global market share, but it's still double the amount of vehicles that were sold in a shrinking market. So there's a lot of places that copper is still going to be very valuable, just on a global scale, not just on a growth scale, but on a secular story as things change, right? And with the Biden administration going more toward electric vehicles, more copper right there. Now, my whole thesis is not on electric vehicles. It can't be 3.2% of the market. I love two chart patterns right now. I love that copper has held up while consolidating off of an up move. As you know, consolidating off of an up move is generally continuation of that up move. The second thing I like is there's a double top forming in the dollar index, which I think takes it back down below 90 to about 89.49. And if you get that kind of weakness in the dollar again, that hasn't triggered yet, full disclosure, but the pattern's there. And I already like the copper pattern. So to me, it's a tailwind that could trigger. And if you get that sort of downdraft below 90 again in the dollar index, you're talking about dollar proxies, that's going to help copper, iron ore, silver. My favorite short-term one of that is copper, because silver has run already.
Good. So what's the trade?
The trade is going to be to buy copper at about March copper contract at CME at about 3.57. It's below that now. So you can get better than where I got in. Stop is about 350. And the target's about 369. You're risking about $1,750 to make about $39.90 on that one.
So and I'm going to love this trade, and there's one thing I wanted to point out that I think I speak for you as well, and I want you to say if I don't. We talk about fundamental analysis all the time, and I like fundamental analysis, but mostly I use it to back up what ends up being a technical entry point. Do you agree with that?
So in Path Trading Partners and in the Stock Think Tank.
Sorry about that again.
I'll come up with a fundamental thesis. We'll be looking at securities, stocks, commodity futures, whatever it is, and I'll come up with a thesis. The technical team, which is just Mike Arnold and his brain, basically overrules me if they want to. They say, yeah, I like this one, but you can't buy it here. But I want to. No, you cannot. So to me, price action and technical analysis is invaluable. You can do all the fundamentals you want. And if you're willing to take big hits while you wait for your thesis, that's fine with me. But one of the things the technical team does that helps us outperform, which we did in 2020, is we get in at good prices. So sometimes we take a loss, but we take less of a loss than we would have. And when we get a gain, there's a little bit of a bump because we got in a good area. So I think it's invaluable.
No, and I agree 100% too. Because and one time, what I try to explain to people who don't really understand chart patterns and technical analysis is that when we come up with a fundamental thesis, chances are that a ton of other people have come up with that before you have. To think you're the smartest and the top of the heap is somewhat, is a little too much hubris for me. So then you look at the chart and see what other people are thinking, because that's kind of amalgam of everyone's opinion. And then you kind of predict how things move based on that. Let's move to oil. I can't imagine that you just gave that very, very eloquent description of copper and why you want it, and then you're going to not say something similar about oil. Am I right on that?
You are right on that. Obviously, the dollar tailwind. So we don't have to waste any more time on that. The dollar tailwind could happen, has not triggered yet, but I suspect that it will. Crude oil has also held up. Now we've got a kind of a dynamic that I'm not super excited about. And that dynamic is the slightly lower refinery utilization number we got this week in EIA. We had a record 18 weeks in a row with refinery utilization below 80. Refinery utilization represents demand on the ground. How much crude oil are the refineries saying, give me all you got? Or are they like, hold up, we don't have anyone to sell it to, right? We spent 18 weeks below 80 back during the fall, during the pandemic in March. That was the record. We tied the record. We're now 4 weeks in a row above 80, but this week was a little bit of a drop. I want to see that dynamic climb back, and I suspect that it will. But while we have rising rig counts in the US, we have slightly falling production the last few months. The last 2 months, so October and December. We rose up a little bit in November, and then we've been falling. So we've got rig counts rising, but those rigs are either less productive or they've already gone through cycles in the bigger rigs that are not producing as much, so the production is falling off. So US production, people used to always say, Jimmy, on the shows that you and I were on when we used to do the old CNBC show together, people be like, oh, they're just going to turn on the spigot. It's not a damn faucet, people. There's a lot of work that goes into getting shale oil out of the ground. It takes a buildup. I think that buildup will come. Also, Saudi Arabia agreed to produce 500,000 barrels a day more, and then basically the next day cut 1 million of their own barrels per day. They're going to try and keep it up. Fundamental thesis. Technical thesis, right, goes right back along to trading in the way that you and I talk about trading. The technical pattern is to buy March crude oil at about 52.50 or better. The stop's going to be at 51.40. I'm not looking for a ton of downside on that because that would be a breakdown of the consolidation, and I don't like that. The target's going to be basically $55. I like to go a couple of cents below, so I'll call it 54.98, especially when you have those round numbers, 50, 55, 60. You'll tend to get a lot of sell orders up there, which is dumb, but it happens. So you're risking about $900 to make just about 24.80 on that one.
And half the amount if you use the mini. The minis in the crude mini is half the amount of the big contract.
Right. So
not quite as liquid as the big contract, but still it's decent.
Right, but with this, because we've got a little bit of room in terms of the price. You can use the minis; they'd be $450 versus $1240 on the reward side. But I want to throw something else out. On those shows that you and I did, not just CNBC, but others, it still drives me crazy to this day when somebody's like, I think oil's going up, so here's how you can play that. Take a look at Valero. Take a look at Exxon. If you think oil's going up, trade oil. Guess
Buy
what?
oil.
100% correlated to crude oil. Guess what? Crude oil. 100% correlated to crude oil. Drives me crazy.
I agree. Here's what I like about crude oil. If you guys can see this chart, I don't know if you can or not. This is kind of crude. This crude oil in about the beginning of January made its high. Has been trading. Bobby just talked about this a second ago. A consolidation pattern. It's just trading back and forth. I love Bobby's trade. I would say my entry point would be I would make it trade above 54. But then you said 55. I think it could go much higher than that. Is there a chance that if you get the move you want and it starts moving, are there times where you take away your take profit and just move your stop up a little bit and see what the fortunes bring you?
I know a lot of people do that. We do trail stops. We tend to leave our target in place. And the only reason is, for me, the only time I'm thinking clearly about a trade is before I put it on. When I'm in it, I'm no longer clear because I'm seeing money, I'm seeing losses. When I think clearly about a trade and I see that there's a possibility it can go higher, I'll do 2 targets, but I always keep that first target in.
You know that I think I'm the smartest guy in the world. I mean, I'm sure I've
No,
told you that many
yes,
times. I think that.
yeah.
And I swear to God, I'm not even joking right now. When you just said that, I was like, yeah, I don't do that enough. I sometimes, when I put a trade on that I really loved and set my parameters up, and then during it, I oftentimes overcook it, just do something stupid in the middle of it. And then in the end, it would have worked out fine. I appreciate that. Seriously.
So you're
Thank
saying
you.
you're the second smartest guy on the planet.
No, no, I'm still the smartest guy. I just, even sometimes the second smartest guy can throw a ball like that. So well done.
Hey, can I throw something at you? I just got texted a question.
Sure. Love questions.
Somebody who's watching the show. How do you all? So it's probably somebody from down here. By the way, I recently moved to Florida. So you're going to have to let me know when the economy is going to spike because of spring, because it's always spring.
Yeah, yeah, great.
So how do you feel? How do you all feel about real estate as a freaking inflation play? And then
I'm all for it. I've been a real estate investor. I dabble in real estate. I've also bought that one. I can't remember the name of that one stock that I own. And again, I'm not recommending anything. The one that's the Florida real estate play. I think the migration in this country has been from cold to warm anyway, ever since the advent of refrigeration and air conditioning. And now it's because of tax purposes. I think Florida real estate, Texas real estate, I think that's an outstanding hedge against a potential cataclysmic currency event. Bobby, you agree?
yeah, I noticed you picked states without state taxes. So I think that was
Amen.
a little caveat in there. What I do like about real estate is that if you're looking for inflation, asset inflation is going to be a part of that as well for the most part. It generally is. People have to know, like when I was doing econ in college, inflation was an expansion of the monetary supply, the monetary base. That was the definition. So we already have that, but it's changed into prices rising based on an expansion of the monetary supply, which is fine. Asset inflation and then price inflation can sometimes be two different things. In this particular case, I think you're likely to see both. We've already kind of seen it with low rates. I will say, everybody keep in mind that if real estate investing is going to be your main investment, you can't get out when you need it. It's not liquid. Because if you're trying to get out, generally everyone's trying to get out. That's what the people in Gamestop should probably be worried about, but they're not. So that's my only caveat on real estate. Invest with money that you won't need, and then get ready to hold it, and you're going to do well. You really don't lose money long-term in real estate as long as you don't need that money you invested.
I would suggest also buying restaurants, and I have one. If you guys want to contact me, no, and just actually joking about that. Getting into the restaurant business is normally people say how stupid it is. We got in. This is tomorrow is our 8-year anniversary of owning Branson Palatine and Palatine. Me and a buddy of mine that I went to grade school with, and it's actually been a great deal. But it was a real estate play as well. Sits on 2.5 acres. Do we have to wrap it up now, Bobby? Is that right?
Yeah, my family, we're just about out of time, but my family's in the restaurant business as well. My brother has a place in Streamwood, actually.
Really? Oh, is it Italian?
Yeah, it's called, come on, what the hell kind of question was that?
Well, I don't have an Italian restaurant.
I know.
Or an IROC.
I had 2 IROCs, and you're asking me that.
Hey.
It's called Franco's Cucina in Streamwood. You tell me if that's Italian.
Yeah.
Yeah,
I like that a lot. Yeah.
He's tired, but they do well. So it's
we
a
do
lot
well
of
as well.
But I've been to Brant's many times. It's one of the best burgers I ever had. So
Appreciate that. And ours had kind of a German theme when we bought it, and why mess with something that's working good? So I'm not changing it to Italian because people seem to like the way it is. Yeah. All right. I'd like to thank you guys again for joining us on Friday. To me, this is fun to me. Right now, I'll probably get a quick workout in, and then I'm going to head to Branson Palatine, have a couple drinks, and keep this conversation going with other people there. It's what I do. I hope you guys enjoy it as much as I do. Thanks again for being here, Bobby.